Hello, corporate taxation students. This is Chapter 7, Corporate Acquisitions and Reorganizations. We're going to move through this material fairly quickly. It is 50 pages. I hope that you guys can make it through the chapters. Try to read at least 5 minutes a day, and maybe in between other homework. It's a lot of information, and it's a lot to comprehend. We may spend the majority of our time on this chapter on Tuesday. So if you could take the quizzes from Chapter 6 and Chapter 7 so we can know what information needs to be reviewed, that would be great. We're going to jump right in. All right. So for the most part, what you'll see is an acquisition of a target by purchasing their stock. You can do this 3 ways here. You can exist as separate entities, subsidiary liquidates into the parent, or a deemed asset acquisition. So the other way to acquire another corporation is to purchase the assets of the corporation. The purchase price becomes the purchaser's basis. The seller recognizes gain or loss. The purchaser has a holding period that starts at the beginning, the day after the purchase. And this could mean that the corporation B recognizes or incurs state, local property and transaction taxes, such as if they sell a car, then the DMV will take in the sales tax from the sale of that car. So when you purchase stock, there is no sales tax. Okay, so when there's a purchase of stock with no liquidation, the purchaser has cost basis in S stock. I think they're using P and S for parent and subsidiary. So, and then the S corporation's operations, depreciation, basis, elections, credits all remain the same. So new shareholder, no tax liability associated with this, and the basis, everything remains the same. It's just basically a new shareholder. Purchase of stock with liquidation, meaning parent buys the subsidiary their stock and then liquidates the assets. So when that happens, the parent has a cost basis in the stock, but when S subsidiary liquidates, no gain loss are recognized and the holding period carries over. The basis in the stock disappears because the corporation's dissolved. The purchase price, if it's greater than adjusted basis of subsidiary assets, then there's a loss of basis. And if the purchase price is less than adjusted basis, then there's a gain of basis. The purchase of stock with an Section 338 election. Okay, so here's where it's in your book. If you turn to page 7-5, it says the Section 338 deemed sale election operates as follows. First, the target corporation's shareholders sell their stock to the acquiring corporation. Then the acquiring corporation makes a Section 338 deemed sale election with respect to the purchase of the stock. This election results in a hypothetical sale of the old corporation and an old target corporation, old T, that's what that T is, to a new T, okay? And the old target corporation goes out of existence for tax purposes only. The new target corporation is treated as a new entity for tax purposes. The basis of the old target are stepped up or stepped down based on the price of the corporation. So here's the thing. You don't want to do this because you have to recognize gain or loss. Okay, so there's not a lot of reason to do this this section 338 election unless the target corporation has NOL carry forwards that haven't been used up. Okay, so you'll read, you can make the selection if you have a 38 or if you have more than 80% stock ownership, and you have to make it no later than the 15th day of the 9th month after the month in which the acquisition date follows. Okay, so here's how the calculation will work. The parent grossed up basis in target corporation stock is added to the target liabilities minus the marginal tax rate of the target times the basis of the assets sold over 1 minus t. So that's the calculation. And when you do that, you have adjusted grossed up basis, and then you allocate over 7 classes of assets. So here's the example. So you're going to allocate new basis over the 7 classes of assets, which are cash, securities, accounts receivable, inventory, other assets, Section 197 intangibles, and Section 197 intangibles for goodwill. GW is goodwill. All right. Taxable versus non-taxable. So the tax consequences, there are tax consequences once the subsidiary liquidates assets outside of the corporation. So Section 1001 on the top of page 7-11 requires that with certain exceptions, the entire gain or loss on a sale of it or exchange of property must be recognized. The target corporation recognizes all gains or loss on the selling of its assets. That's outside of the corporation, right? So if the target corporation liquidates after distributing, and it doesn't liquidate into the parent corporation, gain on the loss or gain or loss is recognized. So if it goes outside, gain or loss is recognized. If it stays inside, basis carries over. In a taxable acquisition, the acquiring corporation uses cash or property to purchase. Target has tax liability. Target's shareholders have tax consequences, and acquiring has fair market value basis in the assets and a new holding period, and their tax attributes disappear. So if they have carry forwards, credits, those things go away. A non-taxable reorg, the acquiring purchases with acquiring stock. So say Nestle wants to buy Hershey. So Nestle, instead of paying cash for Hershey, gives Hershey's shareholders Nestle stock. Okay, so that's a reorganization. No gain or loss is recognized for Hershey or for Hershey's shareholders. Their basis carries over for both the shareholder and the acquiring corporation. The tax attributes stay intact, and it's controlled by Section 368A1. There are 2 types, acquisitive and divisive. Okay, the code section 368 is definitions relating to corporate reorganizations. This is on Cornell's law website. So it talks about the definition of a reorganization. So you'll want to know what this means although you're not expected to be an attorney, you'll definitely want to know what defines a reorganization legally. So here it's a statutory merger or consolidation, an acquisition by one corporation for voting stock, acquisition by one corporation for, for all or part of its voting stock, of substantially all the properties of the corporation, transfer by a corporation or part of its assets to another corporation immediately after the transfer, a recapitalization, a mere change in identity, so you just change name or the identity of an organization, that's fine. That's fine as a reorganization. And a transfer by a corporation of all of its part of its assets to another corporation, and but only if the pursuance to the plan, the stock or securities of the corporation which the assets are transferred to are distributed in a transaction that qualifies under these code sections. So that's the definition. That's what they're following when they're saying section 368. Okay, type A reorganization: mergers, consolidations, triangular mergers, reverse triangular mergers. Here's what that might look like. So we have acquiring corporation, giving stock and property, if any, to target corporation. Target corporation transfers assets and liabilities. Here we have this A stock and property going to target corporation shareholders. The target's its redemption of T stock, so it's going back into the T. And then fourthly, target corporation liquidates. So that's a merger of two organizations into one. So it's A's original shareholders and target corporation's former shareholders. Consolidation looks a little different here. So you can start with one here. So we have new A. So this is consolidation, two targets into one, right? So we have, I don't know if you can see here, we have A stock and property going to the target corporations, the assets and liabilities of both targets going into the new corporation. Then we have the A stock and property going to the shareholders, being redeemed by the target corporation, their stock. The stock right here goes back into this. Same with over here. And they create this new one. These two liquidate. Okay, so what that looks like, this next slide, we have, oh, it's not working, hold on. There we go. So then we have T1's old shareholders, T2's old shareholders, and everything becomes stock in A. Type A reorganization: A stock must comprise 40% or more of stock, cash, property to T. So it cannot, 60% can be non-stock. So in the distribution to the shareholders, if we go back up to this part needs to be at least 40% stock, cash, and property, okay? And T must go out of existence. So both T's in those cases are liquidated and dissolved. Okay, here's a picture of type A reorganization triangular mergers. This is on page 7-24. Triangular mergers are under code section 368. They are similar to straight mergers except the parent corporation uses a subsidiary. So A, parent corporation, B, subsidiary here, to acquire the target corporation stock or assets. The target corporation then merges into the subsidiary this way, not directly into this one. And I don't know if you guys can see my arrow without, I'm not sure how this Screencast-O-Matic works, so if you could feedback on whether or not you can see me circling this, that would be great. I don't think it's working well with the PowerPoint to use the pointer that I have in this program. So they must satisfy the same legal requirements as straight merger, and IRS has defined substantially all to be at least 70% of the fair market value of the target corporation's gross assets or 90% of its net assets. So of the fair market value of its net assets. So this only makes sense if they can acquire more than 70% of the fair market value of the gross assets. Okay. So what that looks like is old target shareholders and new and existing A shareholders have shares in A, which is a parent of S1. Reverse triangular merger, we have the subsidiary merging into the target corporation, and what that looks like after is that the target corporation is now the subsidiary, and the subsidiary is dissolved. So same concepts as before. So then we have type C reorganization. Okay, so a type C reorganization is an asset for stock acquisition that requires the acquiring corporation to obtain substantially all the target corporation's assets in exchange for acquiring corporation voting stock and possibly a limited amount of other consideration, maybe property or cash is listed here. Substantially all is not defined by the IRC or Treasury regulations, but advanced ruling still applies the same minimum standard of 70% of gross assets, 90% of fair market value of net assets. Okay. Type C reorganizations have a stock at the end. The old shareholders, the existing shareholders, and possibly T as a subsidiary. With this type of reorganization, you can only use the acquiring voting stock. They can also add cash or property, but that needs to buy out a minimum of 80% of assets with voting stock. Up to 20% of the assets can be bought with cash or property. A can take on the targeting corporation's liabilities. If A pays with A stock, then they can take out a maximum of 20% liabilities compared to T's total assets. If they only pay with A stock, then the liabilities can exceed 20% of fair market value of T's total assets. Okay, so if A pays with stock, then they can exceed this 20% fair market value. If they're paying with stock and cash or property, then the maximum is 20% of the liabilities compared with the total assets. Drop down C reorganizations. You have a subsidiary. T may or may not liquidate. That's not required. And so you can see the assets and liabilities move into a subsidiary, and this may go away, but it doesn't have to. All right. Type C reorganizations can also use a subsidiary like a triangular, but you cannot do a reverse triangular for type C transactions. or reorganizations. Okay, type D reorganizations, they can be acquisitive or divisive. They must acquire substantially all of the T assets. The target corporation or its shareholders must control A immediately after transfer. They must liquidate the target corporation, and they must distribute stock and cash or property to the shareholders. So here's what a acquisitive type D reorganization looks like. 50% voting stock to the target corporation, and it has to be voting stock, and then 50% of, or 50% of the total value of all stock plus cash and property. Substantially all the assets move into A. The stock and property goes to T shareholders, the stock goes back into the corporation, and post merger looks like this. The target corporation has control over A. Okay, so that's a type D reorganization. If a transaction satisfies both C and D requirements, the transaction is considered a D reorganization. Tax consequences to acquiring target and target shareholders are the same as in the C reorganization. Okay. Type B reorganization. At least 80% of T stock moves into A and redeemed for A voting stock. Okay, T stays in existence, but it's a transaction with the shareholders. Post-transaction, we have T's minority shareholders are less than 20%, and A has existing shareholders, and T's existing shareholders have stock in A. T shareholders don't recognize gain or loss. They have carryover basis in the stock in A, and then A has T shareholders carryover basis in T stock, and holding period tracks. Divisive D reorganization. Okay, divisive D reorganization, section 355. There are different business objectives to this, to divide an enterprise into two or more corporations to separate the risk, to split up the business into two separate businesses if there's shareholders that have different goals, reorganizing and enterprising according to functions, profit centers, or geographical areas. So maybe one corporation is better in a different state than another. Sometimes there's different requirements for different enterprises in different states. And divesting operations because of antitrust laws. So that would be the reasons that you would do a divisive D reorganization split off. What that looks like is that C stock or plus cash or property moves to D. D sells off some of its assets, right? Spinning off here. The stock or property goes to part of D shareholders for D stock into here. And what it looks like afterwards, two separate corporations, right? With each their own shareholders. A spin-off looks like this, where cash or property goes into D, part of D assets goes back into C. C stock goes to some of D shareholders, and D shareholders don't surrender D stock. So the difference between that, the one just prior that we talked about, was that all of D's shareholders are in this existing D corporation and the spinoff, some of them also went with C. So that's what it looks like post-transaction. I know these are a lot of different models and to look at and to think about, but it is important that you guys know the difference and can figure out what each organization is doing when they're spinning off or splitting up or merging or consolidating. Here's a split up. So we have two different corporations that are splitting off of D, right? And then the target corporation redeems all of the stock. So, and there's two different corporations and the shareholders have stock in both corporations. Okay. So for this D reorganization, the following 6 requirements have to be met in order to not recognize gain or loss. They only receive C stock, no hidden motive to distribute EMP of D or C. D and C must engage in business of acquired assets, meaning they can't just transfer assets for no business reason. We've talked about this before. D must distribute all of C stock for plus cash or property it's received from C to D's shareholders. Distribution has substantial corporate business purpose. Again, same with the business purpose. It cannot just be to avoid tax liability. And D shareholders and C shareholders must maintain a continuing equity interest in D or C after this distribution. They can't just be selling it off or liquidating. The judicial restriction on reorganizations, continuing the proprietary interest, greater than 40% A stock, continuing the business enterprise, continue the target's business purpose, and step transaction doctrine. Step transaction doctrine is found on page 7-42 of your book. The IRS can invoke the step transaction doctrine to collapse a multi-step reorganization into a single taxable transaction. Alternatively, the IRS can invoke the doctrine to collapse a series of steps while the taxpayer claims are independent taxable events into integrated non-taxable transactions. Both IRS actions prevent the taxpayer from elevating legal form over economic substance, meaning you can't try to arrange this transaction to look like something different than it actually is. They will recharacterize it back to what they think it looks like. Section 382, acquiring is limited in use to loss corporation tax attributes, and Section 382 is triggered when there is substantial change in stock ownership of a loss corporation, meaning those two requirements below, change in stock ownership of shareholders is greater than 5% and the change of 50% ownership by 5% or greater shareholders within 3 years testing period, meaning the shareholders need to make sure that's the continuing of interest. So if the shareholders then do something immediately different within 3 years, then they can get that step transaction doctrine initiated. Yearly limit of targets NOL utilization. There are limits to using the NOL. When we talked about this code section, we talked about that it might be good to so we talked about NOLs. Sorry, I went ahead and paused the video. We talked about the NOL utilization Now there's a limitation to that. The value of the old loss of the company's NOL is limited to this times the long-term AFR. The applicable federal rates are published. You can Google IRS AFR and you should be able to find those. That's the limitation that you're used every year, and then the rest is carried forward for 20 years. So that loss is carried forward, and you can use that up. So, and that concludes the Chapter 7, Corporate Acquisitions and Reorganizations. I highly recommend you read the book. There's got a lot more examples and a lot more benefits to each of these types of reorganizations and why you might choose one reorganization structure over another, and the business purpose of each. So if you have questions, please email me. If not, I will see you on Tuesday, and we will use the quiz as going forward to define how we're going to proceed with our Tuesday's lecture. Thank you.